Markets today are louder, faster, and more crowded than ever. But one question still remains. What moves the market? Is it headlines or something a little deeper than that? My guest today started on the trading room floor in the 1970s and still actively trades today. He spent more than 50 years studying cycles, time frames, and trader behavior, and believes most traders don't lose because they're wrong, but because they misunderstand one critical thing, which is time. And today we're talking about why being right isn't enough and how discipline breaks down under volatility and what traders still refuse to learn, even after decades in the market. Joining me today is Steve Miller, also known as Slim. Joining me today is Steve Miller, aka Slim. Slim, thanks so much for joining me here on Verified Market Insiders. But hey, I do want to say that we know that you love showing the charts, and I love to talk with you. So at any time during this interview, make sure that you're pulling them up and show them to us, and we'll kind of dive into that in a bit. But first, I just kind of want to go right into it. I mean, we're looking at the markets right now. It's a new year. What's the first thing that these markets are telling you that's different in the environment today than, let's just say, a year ago?
Well, I don't know. A year ago, the market wasn't quite as highly priced as it is right now based on valuations. Um, it was close, but now we're at levels that we've never seen before. Now, most investors, traders, they're not paying a lot of attention to valuation, as we know, because the market keeps getting bought in a very rotational way. We actually were in a rotation a lot a year ago, and we're still there right now as investors find ways to move money out of one sector and then into another sector. We saw AI, really driving the story a year ago, and then a lot of those stocks gave up a lot of ground. And then investors started to look for something else of seemingly that had better value. If you look at this S&P 500, and which by every metric, it is just at an unbelievable, ridiculous valuation. Well, investors wouldn't say that because they believe that earnings will catch up. Still, when you look at the RSP or the equal weighted, you're looking at about a 15% valuation above the norm, which is just like, late stage bull market and maybe just modest correction there. So they're finding value in other sectors at the same time while they have been moving money out of AI. That may be the most distinct difference that we see in the market right now from a year ago. Extreme overvaluation overall, based on AI, but then when you look down under the hood, there's still some value that they're finding.
So when you say extreme overevaluation, what does that signal to you? Does that signal a pullback? Is that looking like more consolidation and just a move higher? I mean, what does that look like for you?
Well, I have maybe a more extreme view about it because I was here trading, 52 years ago, since I started on the CBOE floor in 1974 and was watching the market before that. I have seen these cycles. I mean, I've traded every bull market and every bear market since 1974. And the closest comparison to me is really 1972 coming into 1973, where we had the Nifty 50 stocks that were the ones that were getting bought. The concentration in those stocks was extreme. And that is a lot like what we're seeing right now. And when you look back historically, that period, then we were already really in a secular bear market that you could have measured from 1968. And it lasted till 1982. So people didn't earn money. They had zero returns and some of very negative returns during that period. And I can equate this market more to that period than to anything. I think it's closer to 1972, 73, and coming into what will be a long period of investor angst than even in 1987 or coming into the dot bomb bubble at the end of 99. I just think it's closer to the 1973 situation.
Well, does that mean, immediate drop? Or are we looking at, like, a short pullback and then pop and then, like, a small correction? Or are we looking at a massive move down within a year or 2? I mean, what does that look like for you?
Well, I just did my big picture year-end, video for our members, and what I talked about in there was a lot of gyration this year. I think there's gonna be at least 3 periods where the market has challenges and pulls back. I think it's gonna be a very choppy year. I think it's gonna be a topping year, and the market at some times will look very good and some groups will look very good, and at the same time, because of the valuation situation, because of the political situation, geopolitical situation, angst in society around the country, I think that there is going to be just a lot of volatility that we're going to see.
Alright, that's good for some traders and not so great for some long-term investors, that's for
Yeah, I think
sure.
investors will find it a very challenging year. I think traders are going to love it.
Yeah, that's true. And going back to trading, I mean, what is the market rewarding right now? Are we looking at rewards for position sizes, patience, speed, or is it something else that a lot of traditional traders don't think about?
Well, one of the big changes that occurred in the market a number of years ago, and remember, I'm a floor trader. I come back from trading on the CBOE and the Chicago Mercantile Exchange, the Board of Trade, and so I mean, we just look for getting the edge back and forth, trading back and forth, and a lot of chop in the market was always good for us as paper came into the market. Then things really began to change over the last couple of decades. And a lot of floor traders really struggled with this because the market became very attuned to money flow. That really brought in my type of analysis, which is cycle analysis, looking at rhythms in the market, money flowing in the market. That meant if you couldn't figure out the momentum conditions and had tools to do that, you weren't gonna be able to take the ride. It's really about figuring out not only the timing, but the energies in the market, those momentum conditions, so that you could get on the right side and then not get caught in the emotional side of being wrong. That's one of the real problems for traders and investors is because they don't get in at the right time or they don't understand the timing or the momentum that when things start to go wrong, then the old emotional things that, have us acting ways in our life have us making decisions in the market that are emotionally based and not really process based.
How long did it take you to work through those emotionally based decisions? I mean, like you said, you were on the floor, so, you know, emotions had to be kept in check, obviously, very much more differently than someone who's just, swing trading or things like that. But how do you keep emotions in check like that when you have these sort of markets that, I mean, it seems like they just can't go any higher and they continue higher. And like you said, you're expecting a pullback, but I mean, emotionally, people are trying to get in now at all-time highs, trying to figure out when to exit. I mean, where does that emotional discipline come to play?
It's that's a broad question because the when I work with a trader, when I try to help somebody to get through those emotional issues, it's really not about the market. I mean, the market is the market. It's always gonna do very different things than we expect, or we're gonna get on the right side of it, and it's gonna do what we want, and then it's gonna abruptly stop, and we have to figure out how to react to that. But dealing with the emotions that we have when we engage in the market are about dealing with ourselves internally. It's not market stuff, it's personal stuff. And a lot of investors have a hard time understanding that they're reacting to market moves because it triggers something within inside of us. And that, I don't want this to get away from me. I want to get on this move. Everybody else is making money, but I'm not making money. And all of this is about if they say that, well, that means that they're measuring themselves against somebody else or something else. And then that decision is emotional. They want to catch up, they want to get in, or that's going wrong and they don't get out of a position because if they do, then it's going to mean something negative about them. So the position gets worse and worse, and that whole dynamic gets worse and worse. So it's understanding themselves at a personal level is so important. One of the things that we teach on our website at Slim is that I have about 35 videos that I've done in there on regarding trading psychology, and very much the focus a lot on emotional intelligence and those things. Those are all the kind of work that somebody who's very active in the market really needs to do to be successful. If they don't understand themselves, they're not going to understand the reactions to the market.
All right, and that begs my question, what's then more dangerous, to get in too late or too early?
It's more you can get in too late, you can get in too early, but what was your approach to the market? I mean, if you're getting in with a full position to start because you really need to make the big hit, you're almost destined for trouble because the markets fluctuate. And at some point, the market's going to make you feel like you've got a problem, like you're in trouble on the trade, which affects you personally in some way. And then you don't have room to reevaluate. What I talk about is that, when we do analysis, basically we're looking at stages of entry. Because if we think that something is in a bottoming phase, let's say it's done well, it's pulling back, it's in the end of a corrective phase and ready to move up again. Well, I want, a trader to move in with maybe one quarter or one third of a position and then work on what, we call cannonballing. It's adding to the position when it goes right. I'm not that big on adding to a position when it goes wrong, unless your analysis really holds up and says, well, I was a little bit early. Now I can maybe move to another unit and increase it and get a little lower average on my entry. But I think cannonballing is better, adding to the winner, letting the market tell you that you're right, and then maximizing. One of the real keys to successful trading is understanding how to maximize a winner. One of the biggest problems for traders is that they minimize the winner and maximize the loss. It sets the win loss ratio way off. It sends the size of the win versus the size of the loss ratio way off. You can never be successful when you do that.
Yeah, that's really interesting. I've never actually heard that perspective before, because I've always thought about it where, a level hits, I think, okay, if it flushes through, I have a little bit, it's got more skin in the game, right? So like, if it comes through a level, it's dropping down, flushes through, say, a gap fill, a technical level of some sort. It continues that move down. I always have ads below that where I'm out of the money. But you're saying, if you're in the green, start pushing money toward that to maximize that gain. What happens if it goes against you while you're in the green and now you have not a large portion, but an evenly portion size of your portfolio in that, but you're in the green and now it's pulled through that profit?
Okay, so great question. There's a lot of stigma about having a winner and let it become a loser. And but to me, it's all about proper process. But I want to get the best profit I can on trades that are right. And that means that sometimes I'm going to get a trade that's right. It's going to really look like it's right. And I'm going to add to the position. It's going to stop, come down. I'm going to have a small loss in the trade. Then I have to look at it again. Does my analysis still hold up? Or is there a reason to say I need to get out? I have two measures where it comes to exiting a position. And that is number one, it's met a maximum loss rule. Number two, the analysis doesn't hold up anymore. And then you just get out. And if you have a winner that you add to and it becomes a loser, so what? You're on to the next trade.
All right. So let's go back to your cycles, because I know you're big on cycles. I mean, we just were talking about how this is looking more like the 70s and the 80s, and we've got a lot of room for downside, basically. But a lot of the time I hear people, media, whatever it may be, other traders say this time is different. What does that signal to you when you hear this time is different, being a cycles analyst, that you see these trends? I mean, is this time different? Do you have an example of why this time might be the same as it was back in the 70s? I know you gave a few examples, but what are you seeing on the charts?
Well, I would say that the chart patterns have to first of all, is this kind of different? I want to answer that question. And that is the way it is different is that the market, which I'm anticipating will be making more of a complex top and have several waves on the downside this year, has not proven that yet. So when you look back at 73 and say, well, that's when this market went into a big bear market where it lost well over 45% of its value, That hasn't developed yet. I haven't seen that. If anything, the charts, the momentum conditions, the configurations and shapes of the structures are all bullish. And we have remained that way, saying, since we're agnostic analysts, whatever the information is that is given to us is what we share or what we trade off of. It's bullish right now. And for that reason, all I can do is say to somebody, because the market is super overvalued, that there's a reason for caution. There's a reason for lowering risk in your positions. I don't say that there's any reason to short anything right now, because unless there's some individual stock or something that tells me it's time to be short, there was a big break in Bitcoin recently and there was a short setup in there. I can show that chart and do a little teaching on that if you want. And the for the broad market, everything is still positive right now. In my recent show that I did, I talked about the levels that would give me a sense of a warning or an absolute breakdown, and we haven't approached those yet. So the market is going to need to tell us it's negative. And back in the early 70s, when the market had its break, then the charts told us that. And that's in hindsight, of course, looking back, because I wasn't trading in 73. But the right now, I just have to wait. Agnostically, it's still bullish.
Okay, so do you have some of those, signals that we would have to, hypothetically approach in order to see some of those changes? I mean, is that something you've already charted out? Or is it just you're gonna when you see it, you'll know?
No, I've already labeled them. They're on my charts. I mean, would you like to see those?
Absolutely, let's see them. Yeah.
Okay, so what I'm going to do is I'm going to move in a chart 1 second, and you get an idea of what cycle charts look like when I load this in. And if you could show that chart, you get an idea. So this is the S&P 500. These are cycle analysis charts. They are mostly manually drawn, except for our proprietaries, the indicators that are in here. And what we do is we look for the repeating rhythms that are in the market. So I'm going to expand this weekly chart right over here and then look a little further back. And you can actually see on the bottom the cycle brackets. What those are showing me the rhythms that are in the market and the harmonics that are here in the market. So the harmonics on this chart, and every chart is different, and that's what we do is we analyze those, are 12, 24, and 36 weeks. This is a weekly chart. And if you look at this significant break right in here, that's where harmonics were in a time period of a trough, where all three of them were troughing. That often gives you a sizable decline in the market. After the trough, and we get proven a bottom in there, then you see all three were rising, and that gives you upward momentum. This is our reversal scout. That's our momentum indicator. And you can see in here that it turned positive here. That's where it proves this cycle trough right over there. And that was bullish. So this is the weekly chart. Now we are in these rising phases right here. The momentum moving upward right over here. This puts me in a bullish condition. We've been in a range, and now the market is actually popping out of the top of that range. So I have projections that are in here for these rising phases. And like I say, we're agnostic. This is bullish. And even though I say high value markets are extreme valuations, it's still bullish. So that's what we do. We look at the long side here. So we have positive momentum, positive configurations and structures, and upside targets that are here of 7,025, around 7,100, and this one up here at around 7,318, right up over there. So those are targets. Now, when I switch over to the daily chart, for some reason I'm not getting the daily chart. There we go. So here's the daily chart right over here. And you can see the amazing cyclical rhythms that are in here also, as you see that these cycle patterns are showing you where each of these troughs were. And in this case, this is looking at a 26 bar average cycle pattern. You can see as I go back how these align here further and further back. And what I'm looking at on the bottom is our option bias indicator. This tells you how to keep your option positions. It's bullish. This right over here is our slim ribbon PO, which every time there's an arrow, it tells you of a momentum changing to the positive here or the momentum changing to the negative. I've got to go a long way back to show you periods where it was negative right over here, and you're getting no signals. That was back in the decline back in March of this year. So right now, conditions are very positive. That is showing you the slim ribbon here, the reversal scout, all moving up, all of the indicators positive. And this bullish structure, that's a key, because when you get into periods where the structures give you higher troughs and higher peaks, you're in a bull market. That defines the uptrend. Here you have the same thing going on, so you're likely to make new highs, and that's what we're seeing right there. This level right over here, 68.2431. If that level breaks, the probability of this bull move being over is very high. That's the number that we're showing right now. So right now we're 69.71. So it's only 150 points down from here. It's less than 3% decline will give us a bear market signal or a bearish corrective signal. In the meantime, what we're looking at right over here is a condition that continues to point well to the upside, looking at that. And again, here is the cyclical patterns on the weekly chart on the left, right over there. And here are the cyclical patterns on the daily chart. And this is how we use multiple time frames. The information on the weekly, which is strong, tells me the daily is likely to configure bullishly. Over here, all of the indicators over here are telling me that this upside is likely to continue. So you go from one piece of information to the other, and that's what multiple time frame cycle analysis looks like.
All right, so I want you to bring up that weekly chart because this is very interesting. You have the 3 down troughs, right? That lines up perfectly with a pretty important date in April, Liberation Day. So that begs the question, which comes first, the news or these cycles, or they just kind of go hand in hand? I mean, that's pretty, I don't know. I mean, it just lines up perfectly that
Yes. See,
Liberation Day
here,
happened to be down this.
that's a great question. And the reason for that is because the um, it's a chicken egg thing, but to me, it's not about as much about the timing as it is about the magnitude. Because, when we were having mostly the large declines, they were, in periods that lined up for that. But then there was also, news in the background. The Trump tariffs were scaring the market. So what caused the market to peak over here? Was that Trump tariffs? Or was over at this point right over here? Or was it just that it was time for this corrective period to begin? Maybe the correction wouldn't have been this deep as it was if not for the tariffs. Maybe it would have been just a modest 6 or 8 or 10% correction and then moving up again. The same thing for when you look at Liberation Day over here, it moved up extremely sharply. Well, if you didn't have Liberation Day and you didn't have that news, well, maybe the magnitude would have been less, but the timing would have been similar. That's really what's important. It's the timing is the timing. It's money flowing in and money flowing out. These brackets on the bottom do not say anything other than an average time period between this money moving in, money moving out. They're not determining anything. They're just a guide to let me measure what's happening in here. I mean, I'm going to switch over to Bitcoin for 1 second, just so that you can get an idea. When I look at the Bitcoin chart here, this is what most people look at. They'll have a moving average or two or something like that, and they'll have a chart like this and they'll draw lines in it and they'll try to figure out, well, is this bullish or bearish? Is it done going down? Is it not going down? What's the timing in there? But then when I move in the cycle analysis and do that, then all of a sudden you've got some amazing picture in here of the money flows as it moves in and out. You can see in here where these were aligning, that's Ethereum, and you've got the correction where it was likely you'd get to a new high in here, which it did. When the failure came under that level, which is similar to the level on the chart like I gave you in the S&P 500, once it breaks down, then it falls through to that period. Timing of the money flows, as you could see, money in, money out, money in, money out. That's just how it works. That's the weekly chart. If you move over to the daily chart, you can very much see the same thing because the Bitcoin action in here was just fantastic looking at this chart. Look at those rhythms that are in here. And when you look at them side by side, you can see that on the weekly chart where there was a bottom due somewhere in here that also had synchronicity with the bottom due on the daily chart right in here. And that tells me we're likely in a rising phase, momentum turning up. Our right there is the first green dot on our option bias indicator. This now the slim ribbon PO turning neutral. And you can see that I can now get a projection. This cycle moving up, this cycle bottomed and moving up, and an upside target up over here of probably 97 to 100,000 and potentially up here to about 104,000. This is all how I do it. Money flows, targeting, momentum, putting all of that together is really the key when I look at that. So I figure I'd just show you the Bitcoin chart also because that gives you a very good idea. Now, I've been extremely negative on Bitcoin, though it's technically, and I have other reasons to think it doesn't have great utility. But it doesn't matter. Right now, it looks like it's pointing up. It looks like 98 or 104,000, and that's what I show.
All right, 'cause
Agnostic analysis.
it's had a hard time breaking that 90 to 95,000. I mean, it's been trapped there for several days now. I mean, after all-time highs, like you said. So, I mean, according to your cycles, it's looking like it's gonna break that relatively soon.
You mean break the lows or move up?
Break the 90 to 95 kind of cap and ceiling, or the ceiling and floor that has been stuck between for, it seems like a
Yeah, I would guess the highest, I would say probabilistically, based on the shapes of everything I'm looking at, I would give it at least a 70% probability that it breaks out of that range on the upside.
So what happens when you're looking at charts and you have conflicting, analysis? I don't know if you go as far into maybe day trading as those are more long-term daily and weekly charts, but what if you have conflicting analysis where you see, say on daily, that you have a head and shoulders pattern, but the cycles look to be more on the upside than more of a trough? Are you looking at more of the cycle side of things or the technical analysis, or how do you
Well, it
play?
really depends on where that exists, that pattern. If I have a daily head and shoulders top that is existing at the point where it's pretty obvious that the weekly or even the monthly is in a positive configuration, the longer the time frame, the more dominant it is. That would mean the head and shoulders top has a greater chance of failing on a daily chart if the weekly is bullish. So we look at that, and we have algorithms and we have applications that we offer that allow you to see the sum total of what all of these different things mean. So it's an application that our members can download, and they can just see if something is very bullish or moderately bullish or neutral. And when there's a lot of fight going on, it's going to give you neutral readings or slightly bullish or slightly bearish. It's important because remember we're really staging the size of our trades if you're doing it properly. So if you're bullish, but then the reading is neutral, you know, you might put on a 1 unit trade or something like that, but you really want to only enter on the side that can give you the biggest hit, and that is where's the highest probability of the impulse. And that, we try to put all of those things together. And it's really important to understand the concept of time frame dominance. And that is, if you're looking at a daily chart, but you have no clue of what the weekly or monthly is saying, you're not understanding the dominant energies that are in the market.
So if traders say are only looking at that daily, which can be a problem. I mean, especially if you're trying to go quickly and traders, trying to get into a trade quickly and only looking at one cycle and one time frame. I mean, they can miss a lot more if they're not putting in the bigger scope of things on, say, like you said, a more dominant chart like the weekly.
Yeah, I mean, it's we really stress that you've got to be looking at multiple time frames. Now, if somebody is a scalper and they're looking at 3 minute charts or 5 minute charts, that's really a whole different story. If somebody is a swing trader or investor, then they've got to look at multiple time frames. But even our day trader system offers our chart analysis and momentum conditions in 3 minute, 8 minute, and 15 minute. So we're always encouraging what these different time frames mean and the importance of understanding them because you want to get on the biggest impulses. That's the key to success.
And also to the key of success is, I mean, going back to managing emotions on top of all that. I mean, so you're looking at charts, you're looking at time frames, you're looking at cycles. It's a lot. And then you have to manage your emotions. And honestly, the cycles part of it is so fascinating to me, as well as technical analysis, because that's what I do on a daily basis. But the psychology of it, I find that new traders, old traders, no matter what, it's always a learning process to manage your emotions. So my question goes into kind of one of the final questions here. What breaks some of these traders faster? Is it losing the large amounts of money, or is it being impatient while getting into the market or getting out of the market even?
Well, I think there's different stages of that. If you talk about an early stage trader, somebody that's coming into the market with only, a moderate amount of money and just trying to learn the market, I think that focus on money versus process it turns out to be one of the most challenging things, especially for new traders because they come in with just a limited amount of money. They don't have much money behind it. And they start to lose money. And yeah, it's usually bigger than they really should be losing. And instead of focusing on building the knowledge base, understanding the markets, how to get, some kind of an edge in their trading, they're focused on money and focused on money that they make. And all of a sudden they feel good about it, or focus on money they lose. And that triggers a negative sense of self. Trading is one of the things that is really the hardest on our own personal sense of value. When you've got that issue, then you're going to end up having a lot of trouble. Now, traders that are in the market for a longer period of time, it gets to be a little bit different because they may have had long successful periods, and all of a sudden the market changed. Something is different. What worked for them all of a sudden doesn't, and now all of a sudden they're starting to challenge whether or not, hey, did I ever really understand this? What was I doing before, but now I'm not doing now? The market is messed up. They go into victim mode. The market is doing this to me. And once you get into that mode of victimization, that the market is responsible, or some other influences like something the president says or something like that is responsible, then you stop taking ownership. And once you stop taking ownership of your own trades, it's over for you because then you're going to start to look for something else or blaming something else. If you're blaming something else, then you're not going to fix it. If you take ownership about it and you know it's about you and you know there's going to be work to get back into what is the winning mode for the current market conditions, then you can get back on track. So they have to make sure that they're not losing so much money during the periods where all of a sudden things start to go wrong for them, that there's such a massive attack on their personal sense of value that they can't recoup. And a lot of traders don't know the importance of actually, having a trading buddy, a confidant, even a coach that can help them get through those periods. That where they're starting to personalize things and forgetting about all the work that they originally did to try to understand the market.
Slim, I can't tell you. I think every trader watching this knows how wise of words that is, and that is extremely helpful for anyone out there. That was very insightful. So thank you for sharing that. Also, thank you so much for the charts and the analysis. I mean, I find that so fascinating, especially with cycles, and just how some of those cycles have been playing into eventually momentum swings. Say like in April, Liberation Day. So it's all so fascinating, and the markets, they just continue doing what they're doing, and we just trade them like it is. So Slim, I do want to ask, where can people find you and maybe more of your analysis, or even if they're more interested in the psychology of trading, where can they go to find more information about you?
Well, they want to go to my website at AskSlim.com. I have that up there now. I don't know if you'll be able to share that.
Yeah, it's right there.
Okay, got that. Okay. So the amount of information we have here on AskThem.com is just mind-boggling. You can go to the front page right over here. By the way, that picture right there is me with my hands up on the CBOE trading floor in 1974, trading in the Ford and IBM pit. Right over there. My badge was SLM, and that's how I got named Slim on the first day that I was there. By the way, my grandkids call me Slim, my wife calls me Slim, my parents call me Slim. So it's Steve or Slim, whichever you prefer. If you scroll down on this page, you can get an idea of a lot of things that we offer, and you can see all of our trading plans right in here and specials for our memberships that are there. And there's just so much that I could show you. We have a new investor hub. We share all of our charts for members. Our team, there are 4 analysts, and they have a Discord channel that they do. They answer member questions. They offer support for traders. I have over 1,000 videos in here that people can learn from trading psychology to learning how to do the technical side. I have over 80 videos on technical analysis. And I've done most of them, but my team is now catching up and doing a ton of them also. You can watch my show on YouTube on Fridays called Market Week. And we have a Wednesday show for our members called Future Speak that our analyst RV does a fantastic job. And that is where he looks at 24 different futures contracts and shows you the kind of analysis that I did on all of those futures. And if you want to just get a taste, go to free stuff right over here and go to Snapshot Lite, and you will see that you can sign up for the free S&P 500. That's what we call the Snapshot Lite. All you do is put your name in there, no credit card. You'll get our analysis on the S&P 500 every single day for free. So that's a way they can really start to get a taste for what we do and learn from a really fantastic team that we have here at AskSlim.com. One more thing is that see down over here where my picture is right over there, that's Slim AI. You click on that, it's like you're talking to me. Just hit start a call. It talks in my voice. It's completely trained in everything that I've ever done. And it will, for members, it's fully versed in everything that I do. If you are visiting as a visitor to the site, it will tell you about what we have on the site, but it won't share anything of our proprietary information. So it's a great way to talk to me. My virtual twin is amazing. So that's everything I have to show you there.
Awesome, Slim. Well, I really appreciate talking to the real you and listening to all of your insight. It was very fascinating. I really do hope that you'll come on again. But for now, I just really appreciate everything I had to share today.
Well, glad to be here.
Yeah, thank you so much. And again, if you like the YouTube video, like and subscribe below. We'll be in touch with Slim shortly. Thanks, Slim.
Okay. Thanks a lot. Bye bye.